Welcome to the W4.0 Weekly Roundup. This is where we cut through the noise and take a closer look at what really matters in markets, economics, and in policy. This week it's been a little bit quieter than usual on the corporate front, but there's been no shortage of meaningful developments. A host of diplomatic manoeuvres over Ukraine, and a fresh dose of UK inflation data, and some curious murmurings about stamp duty, which Neil will talk about a bit later. As always, I'm joined by Neil Woodford. Neil, why don't we start with the geopolitical headlines? And this week they've been dominated by Trump, Putin, and Zelensky's peace talks. They've been trying to broker a peace deal in Ukraine and started in Alaska with a summit with Trump and Putin, and then there was a flurry of meetings with European leaders at the beginning of the week. What is your assessment of these developments, and is there real hope for progress now, or is this just more theatre?
To cut to the conclusion, I'm less hopeful now than I was maybe ahead of the Alaska summit. So let me explain why. I mean, I think there was some hope that Trump would be able to at least use some leverage over Russia and Putin to extract some form of concession that would help lead to some sort of peace settlement. Well, initially, I think there was hope for a ceasefire that might then lead to a settlement, but I think Russia was pushing for a peace deal before or without the need to go to a ceasefire. Anyway, the long and the short of it is that as the week has progressed, I think it's become increasingly clear that Russia's position really is pretty intransigent, and there is very, very little on the table, if anything, as far as I can work out, in terms of Russian concessions. And as a result of that, I think I have to say my optimism about a peace settlement or any sort of ceasefire deal has pretty much evaporated. I mean, I heard yesterday from Russia's foreign minister that Russia was insisting that any sort of force that was guaranteeing Ukraine's security would have to involve Russian and Chinese forces, which I thought was so bizarre to be well, it's not funny, but I mean, I thought it was ridiculous. The idea of Russia guaranteeing Ukraine's security is a bizarre sort of twisted notion in the first place. So look, that's never going to be acceptable to Europe or to Zelenskyy or Ukraine. And so as a result of the sort of toings and froings and the information that I have based on what I've read, I think a peace settlement, peace deal, ceasefire is a long way off now. So I think the war goes on, unfortunately.
We saw European defence stocks selling off at the beginning of the week, as well as oil prices starting to edge lower. Do you think, I know you mentioned when we spoke last week that you thought a sell-off in defence stocks would be a mistake. Is this the market pricing in the possibility of a peace deal, do you think? Or is it just another case of the markets not really knowing what's happening?
I just think the market is noisy and irrational at times. I think defence stocks have done incredibly well in recent years, largely because of what's been going on in Ukraine. Europe's commitment to rearm and to massively increase its defence spending is obviously good news for a whole range of European defence stocks. They performed incredibly well. Any sort of any move towards an event that might end the war obviously is a sort of trigger for a catalyst for people to take profits in what have been very good, very well performing shares. So I think it was no more than that. It was just a sort of an understandable sort of short-term noisy market reaction to the initiation of some sort of process that might have led to peace. As it is, it hasn't and won't, in my view. And so I think the optimism that underlies what has happened, well, the optimism for defence spending that underlies the share price increases you've seen across European defence stocks is likely to continue, I think.
Turning to the UK, the ONS once again delayed one of the key data releases. This time it was retail sales. Clearly, there is still an ongoing problem with UK economic data. This is something you've been vocal about for some time. Is this now a systemic issue in your mind, and what can be done about it?
Well, I hope this isn't a systemic issue. The ONS clearly has some major problems, particularly with survey data. They would argue that the problem is that the respondents to the survey data have just stopped filling in the forms. I think the problems run deeper than that. I don't think it's just a lack of response rates or low response rates. I think there's more to this than that. I think the ONS's approach to measuring the economy is fundamentally flawed, in which I've talked about before. I think they've misrecorded productivity, they've misrecorded output. Clearly, there's a reliability problem across a whole range of data series. So we saw, for example, earlier on this week that there'd been some reasonably significant revisions to GDP data from the COVID period and the immediate aftermath of COVID. Look, I don't want to sort of blow this out of proportion. I'm not saying that this is some sort of really systemically disturbing issue that will undermine confidence in the economy. I don't think of that at all. But the issues that I think have been obvious at the ONS for a long time, and which I've written about for some while now, and which others have written about, I think is beginning to be more broadly understood. And I think action is now taking place to try and correct the problems. I don't think that will be an easy task. I don't think this will be solved overnight by any means. And one of the most important issues is really how the ONS grapples with measuring GDP. This idea that you can measure output monthly is, to me, a fantasy. This is inherently a very complex economy to measure. Trying to measure output is, in my view, the wrong way to measure the economy. And there are better ways to do that. Those better ways seem to be the methodologies that are adopted in our peer economies. And I just think we need to sort of embrace an important change in how we measure the UK's output.
Despite those delays, we did actually get the UK inflation numbers, July inflation numbers. CPI came in at 3.8% for July, higher than many were hoping for. Did anything stand out to you in the detail, and how do you think it shapes the outlook?
Look, we know that inflation is going to remain higher in the short term than I would have liked. The increase in inflation that we've seen coming through is a product of what I called administered inflation, and it's essentially the product not of some sort of demand-driven problem in the economy or a supply problem in the economy. It's pretty much the product of price increases that are the product of fiscal changes or regulated changes. So we've seen water charges, electricity charges, gas charges. We've seen bus fares, vehicle excise duty. All these things have contributed to the increase in inflation that we've seen. In the real economy, away from those administered price increases, we've seen the after effects of the government's national insurance and labour market reform. So increases in the minimum wage, increases in effectively the tax on employment, meant that companies had to react to preserve margins, particularly in the food sector where margins are very low. And you've seen food price inflation pick up as a result. So it seems to me that the inflationary blip that we're going through now is not one that should worry policymakers. It is purely and simply the function of policy changes which have created this higher inflation. It's therefore temporary. It's not going to persist. And really, the MPC should be setting interest rate policy based on not on what's happening today or tomorrow or next month, but it should be basing policy on where it thinks inflation will be in a year, 18 months' time. And in my view, inflation returns to the 2% target in about the middle of next year, based on base effects and current energy prices and how inflation is likely to sort of pan out over that period of time. So this high inflationary blip that we're going through now won't last, and I think this will be important for consumers, for the fact that inflation subsides, will remove the sort of constraints on policymakers to reduce interest rates. So I do see interest rates continuing to fall. As I've said, there'll be another cut in November. I'm pretty confident about that, and there'll be further cuts in interest rates in the first half of next year.
There's been a lot of chatter this week about stamp duty, rumours that it could be scrapped entirely. What do you make of the speculation around this, and do you think this is something the government would actually go through with?
Yeah, this is an interesting idea. So the sort of gestation of this is that in the lead up to budgets and in the lead up to the OBR's assessment of where the economy is, all sorts of ideas are noodled around in the Treasury, and those ideas tend to involve all sorts of different people sort of coming together to discuss the impact of potential changes. So I would imagine that the stamp duty land tax abolition idea came from a sort of working group who might be looking at the impact of what the impact of getting rid of stamp duty might be. I mean, it is a bad tax in my view. It has constipated the property market. It's been economically damaging, and the revenue from SDLT has been falling in real terms significantly over the last 5 or 6 years. So it's not working as a tax, and it's holding back the economy. So it would be a good idea to get rid of it, but of course, the revenue that is raised from SDLT would obviously go in the short term, and I think the noodling that's going on in the Treasury is sort of, well, what happens if we get rid of land tax, stamp duty, land tax? What happens to the government's tax revenue? How is that made good anywhere else, etc.? And those discussions involve people like HMRC, the OBR, I'm sure people from the Treasury. There are other people probably involved, maybe even the Land Registry get involved. Now, in all those discussions, it's inevitable that somebody says something to somebody else and there's a leak. And hence we have the sort of discussion that we've had this week about what the government might do to stamp duty land tax. As much as I think it will be a good idea, a very good idea, and it would liberate the property market, I think it would automatically lead to higher revenues from higher consumer spending. It would be a very good development for the economy. I think it is a sort of bridge too far for this government, for all sorts of political and revenue sort of raising reasons in the short term. So it's part and parcel of the sort of the kite flying exercises that go on ahead of all budgets. I wish there was more confidentiality around these discussions, because I don't think it's very helpful to have these sorts of stories in the media, because of course they do result in people sort of stopping what they're doing, waiting to see, waiting for clarity. So I think that in the short term, this kite flying is counterproductive. There's lots of other speculation about, well, if stamp duty went, what would replace it? And that argument slightly misses the point about, well, if you get rid of stamp duty, you get an economic benefit. Replacing stamp duty with some other tax that clogs up the property market would be a terribly bad idea. So I as much as I think that they won't have this won't happen, I think it's a sort of an interesting sort of debate. I think it's highly unlikely that they'll be brave enough to do it. What I don't see happening, with the timescale we've got to the budget, which is likely, although we haven't got a date, it's likely to be in sort of late October or early November. There just isn't the time to sort of formulate what new tax might replace it and how that might be levied. I just think that's not not a likely scenario. So I think this is just a debate that's been had, it's been leaked. All sorts of people are sort of scurrying off in all sorts of directions, putting two and two together and not making four, in my view. As much as I think it would be a good idea, I don't think it's going to happen. But as a broader sort of point, and as I've written on numerous occasions recently, there is no need to raise more tax. The 50 billion hole that everybody keeps writing about in the nation's finances is a mythical hole. It is entirely the product of ridiculously conservative growth expectations over the medium term to the end of the decade. The National Institute of Economic and Social Research used those growth numbers to produce this answer that there would be a fiscal hole in the government's budget. It's the product of their very gloomy growth forecasts, which I've said would mean that the economy grew at under half the rate that it's grown at on average over the last 25 years. There is no good reason for that to happen. Growth this year will be 1.5%. I can see growth accelerating next year to 2%. The idea that growth would slow next year with lower interest rates, lower inflation, no Trump tariff uncertainty, it is to me silly. So the economy accelerates next year. The 1% growth number that the National Institute were talking about seems to me to be rubbish. So in my view, ignore this silly story about a 50 billion hole in the nation's finances. It's a myth. Borrowing is bang on target with the OBR's forecast. First 4 months of the year, 60 billion is the budget deficit. That's exactly the number that the OBR forecast in the spring statement. The July borrowing number was better than expected. I expect the August number actually to be better than expected for various reasons. I really wish people would just stop wasting their time talking about something that is likely to be harmful, really, to consumer confidence.
Let's talk about borrowing for a minute. The July deficit came in well below expectations, 1.1 billion versus the forecast, and it even showed a surplus once the investment spending is stripped out. That seems to be a sign of stronger public finances, I think, or is that just a temporary sort of quirk of the data?
To some extent, it's a quirk of the data. July is always a good month for receipts because of payment on account, which tends to come in July. My understanding is HMRC is saying that lots of people are late with their payment on account checks. So that's why I think August number will be better than expected too. But the July number was better than expected. It's normally a good month. Last month, July was a surplus month too. This month there was a small deficit, but let's not get into the weeds. It was a good month, better than expected. Over the first 4 months of this fiscal year, the deficit, as I've said, is bang in line with forecast. Tax revenues are up 7.25%. National insurance revenues are up 17.5%, which is a huge number. Government spending is up 8%. I think that number speaks to the ridiculous increase in government spending that we're enduring at the moment. But the growth in government spending will slow and will move in the next few months back down to about 3%. My guess is as the economy doesn't collapse, which seems to be the consensus view, if the economy delivers the growth number that I'm very confident about, which is 1.5% this year and 2% next year, the deficit falls and the current budget will be in surplus in the 27-28 year based on those growth numbers. So I just don't see what the panic's about. Clearly, in my view, the government is borrowing too much money, the government is spending too much money, but there isn't this sort of £50 billion crisis that the media seems to be obsessing about at the moment.
Neil, you mentioned a new consumer survey that had just come out that shows that consumers are getting more confident about their finances. Tell me, what did you see in the data that leads you to believe that consumers might be getting more confident in the future, and what might that mean?
Yeah, look, I only mention this is because I I feel that there is a sort of an overwhelming atmosphere of gloom and doom about the economy. And the reality, as I keep saying, is very different. I'm not a big fan of sentiment surveys, but nevertheless, the survey that I'm just going to talk about is one that's reasonably highly regarded. It's one that is generally followed and is respected. It's a GfK survey. And what it shows is that consumers are more confident about their household finances and more confident than they've been for quite a time. And interestingly, one other aspect of the data showed that they're saving, reflecting that improved confidence about their finances. Their saving intentions have declined. Now, this is something I've talked about for a while. Really, what we need to see is lower interest rates rebalancing the relationship in the UK between household saving and borrowing. And that's an important factor, if you like, that will drive better growth in the economy. Less saving, more spending effectively. Now, maybe it's very early, but we're at a very high level of consumer saving at the moment. I mean, the official data is that consumers are saving 12% of incomes, which is a very high level, much higher than the long-term average. This sentiment survey just, shows us a decline, if you like, in the desire of in consumers' desire really to save, and it reflects that increasing level of confidence in households in their financial situation. So I don't want to sort of ascribe too much importance to the survey. I just want to highlight it because it contradicts once again the data contradicts the overwhelmingly gloomy view that the media keeps shoving down our throats. It's just wrong. It's not accurate. The UK economy is the fastest growing G7 economy in the first half of this year. If we grow at 1.5%, the outturn for this year, I'm pretty confident it'll be 1.5%. The outturn will, for the whole year, will show that the UK economy is outperforming its G7 peers. That, life is not perfect. There are lots and lots of challenges. There are lots of problems in the UK, but it's nowhere near as bad as the media would have you believe.
So a nice little bit of Friday cheer then, heading into the weekend.
Yeah, and the sun's shining.
Neil, thank you again for your time. That's all for this week's weekly roundup, I think. We'll, of course, see you next week for W 4.0 members. The latest members-only Q&A will be available for you to watch later on today. But that's it from Neil and I. Thank you for joining us, and I hope you have a great weekend.